A very good afternoon and welcome to 2024. This is what we're going to be looking at this week. A major narrative to sort of get our head around is with the US data that's coming out and how that relates to the latest Fed's dot plot and short-term interest rate projections. So looking at the Fed's dot plot, you can just see nice and simply that the Fed's expecting 3 rate cuts for this year. Now, short-term interest rate markets see significantly more interest rate cuts this year, and they've got short-term interest rates moving as low as 4% during this year. So you can see that is a 5, nearly 6 interest rate cuts that short-term interest rate markets are expecting. So all US data this week is going to be read in light of those two different views. Is it the Fed's view, which is correct, that there's only 3 rate cuts due, or is it short-term interest rate markets, which is going to see a deeper and more extensive set of cuts? So that's sort of just by way of introduction for the US data that we have. And of course, that's going to be very interesting for the great run we saw in stocks in 2023. A lot of analysts completely wrong-footed with this great bull run we've seen throughout 2023. And you can see we're right up at all-time highs. The Dow pushing above January 2022 highs, NASDAQ up above those end of 2021 highs, S&P 500 up at those end of 2021 highs. So, what are we going to see? Are we going to see an extension of that broad bull rally, or are we going to see a pullback? So all the US data this week is going to be read in light of that. Has this broad bull run got too far too soon, and is there sort of a significant pullback and consolidation, or is the US economy just doing better than everyone's been thinking? Deflationary pressures are coming back. The Fed's finished hiking interest rates, so we're going to see an extensive run for 2024 as well. So we've got to be nimble, we've got to be clever, because a lot of these narratives, they're completely contradictory, and the short-term opportunities will be the quick reaction to investors thinking, well, hang on, this is the right narrative, or that's the right narrative. So that's sort of by way of introduction for the US data. Now, as we go through the session starting today, pretty light on the data front. We've got global manufacturing PMI, but it's the final data out for the US, so unlikely to see much action there. And as investors sort of put their feet back under their desks, they'll be reluctant to be jumping into any fresh stimulatory moves. However, by the time we get to Wednesday, you're sort of the second day into your desk, and you might start seeing some reaction to calendar data points. If we look at the Eurozone data that's coming out early on Wednesday, unemployment rate for December, again, if you see very good unemployment data coming in significantly below market expectations, but with market expectations sort of flat at 5.9%, and it's still quite early on in the week, I wouldn't be expecting much moves from that Eurozone data. But the Eurozone as a whole, Christine Lagarde said in her last interest rate meeting, didn't even discuss interest rate cuts, even though the ECB projected both inflation and GDP to fall lower in the coming weeks and months. So if we see a big increase in unemployment, then you could see a little snap lower in the euro, but ideally want to see stronger European data will be the most likely reaction to lift the euro, and that will be just pushing back against some of the negative news that's been priced in for the euro into the end of 2023. So we'll come back to that when we get some better European data throughout this week. Looking at the ISM manufacturing PMI print, again, weak manufacturing is not a surprise, but strong manufacturing would be. So if we saw this ISM print coming in significantly above market's expectations, coming in 48.5 or higher, I'd expect that to lift the dollar. That should send yields higher. That should be a short-term negative for gold, and it should be a short-term negative for the S&P 500. But if it comes in significantly below market expectations, 45 or lower, expect that to send yields lower, the dollar lower, and expect that to lift gold and lift S&P 500 in the near term as investors start to think, there'll be even more rate cuts coming from the Fed this year. Don't forget the other factors as well. Manufacturing prices paid, that will be an indication of inflationary pressures, strong inflation, should be hawkish for the Fed to hike more rates. Weak inflation should be more dovish for the Fed not needing to hike interest rates so aggressively. Then we have some Australian PMI prints out overnight. Might see a reaction in the Aussie dollar if this comes in, very, very strong. So if we look at the outlook for the RBA at the moment, you can see short-term interest rate markets. They've got rates falling now, 4.35%, the current rate. Short-term interest rate markets do see cuts into this year. So anything very strong and inflationary would likely lift the Australian dollar, as it might just sort of delay some of these projected rate cuts for Australia. Inflation is still pretty high in Australia, and inflationary pressures should lift the Australian dollar in the short term if we see any surprise data points to the upside. Don't forget, risk is generally impacts the Australian dollar. So if there's any very negative China sentiment, as we started the week with this Chinese data weaker than expected, with the manufacturing PMI coming in one of the weakest prints in the last 6 months at 49, in line with the low forecast. There is a lot of negative sentiment about investing in China at the moment, and that's a natural headwind for the Australian dollar. So just to be aware, if sentiment improves or gets worse for China, if it improves, that should give a further boost to the Australian dollar. If it weakens, that should weaken the Australian dollar. Then looking at the 4th of January, we got some PMI prints coming out. It's the final data point, so not expecting much of a surprise there. The best surprise would come from an above expectations print. So if this did come in above the high expectations, expect that to lift the euro in the near term. With so much bad news priced into the euro, positive PMI prints, even this is the final data, not expecting much impact on the final data. But if it does come in much stronger than expected, that should lift the euro. CPI print, again, if it comes in much higher than expected, above 4.2%, then expect that to lift the euro. If it's lower than expected, then a lot of the sort of weak news is already priced in. So I would favour higher prints for euro strength in the current conditions. UK PMI prints is the final data again, so really not much of interest there. This is the Eurozone. We've got some data coming out for Germany on the Thursday. Yeah, that's the CPI data coming out for France and Germany. Again, strong data look to lift the euro. So if we do see a strong print here out for Germany, if it comes in at 4.2% or higher, expect that to lift the euro. And then we'll get to the main data out of the euros will be on the Friday. So this is just sort of the warm-up act really with France and Germany. We'll set the tone for the Eurozone, and I'm only interested in trading surprises to the upside. So surprises to the upside, 4.2% or higher, 3.9% or higher, coming in above expectations, lift for that to lift the euro, and look for a weaker currency around the time. US initial jobless claims, again, what we're looking for here, if there's low number on the initial jobless claim, so less people are claiming joblessness, then that should weaken the dollar, that should lift stocks, that should lift gold. So if this comes in, significantly lower, below 212, then expect that to lift S&P 500, lift gold, weaken the dollar. If it comes in much higher, if more people are claiming joblessness, that's more negative. Actually, scrap that. Okay, I've misled you. Just ignore what I just said about the jobless claims and listen to this. So if the jobless claims comes in high, 230,000, that will mean that more people are claiming joblessness. So the Fed will be more likely to cut interest rates more quickly. That should sink the dollar. That should send yields lower. That should lift gold and lift S&P 500. So to be clear, 230,000 or higher, okay? And if you see the jobs coming in 60,000 or lower, you would expect that to send the dollar lower, lift gold, lift stocks. Apologies for the mix-up. They're still finding my feet post-Christmas and New Year. If we get the opposite, so if you get less people claiming joblessness, so if it's 212,000 or lower, and the ADP jobs number comes in 142,000 or higher, then expect that to send the dollar higher, expect that to send yields higher, and that should send gold lower and stocks lower, because the Fed, the US economy can take more interest rate hikes. Okay, so that's the big picture to look for with the US data against the final print. So I'm not too interested in the final data prints. Very interested in the data coming out on Friday. It should be a good day. We've got the HICP, which is the ECB's targeted inflation level. And what they're looking for here is they're looking for the year-on-year data come down to 3.5% from 3.6% for the core reading year-on-year. And the headline, they're looking to come in at 3%, up from the prior 2.4%. So what I'm looking for here is anything surprises to the upside. So I want to see above 3.4% for the headline, and I want to see the core coming in above 4%. So if I get the core above 4%, the headline above 3.4%, expect that to lift the euro, because it will likely mean that the ECB may need to hike interest rates. And if you look at the short-term interest rate markets, the expectations are that the ECB has finished hiking interest rates and they're just going to be heading to interest rate cuts. But if we start to see inflation picking up, moving back in the wrong direction, back up towards 4% for the core reading, and for the headline, moving back up above, 2.9, up 3%. If you start seeing that moving in the wrong direction, then that's going to increase expectations that the ECB may need to, either be higher for longer or maybe even need to have another interest rate hike. That'll be an important data point. The ECB look for a target, around 2%. And so we're still well above that target. Then have the obviously very important US non-farm payroll data. This will be important. Jobs data, key focus of the Federal Reserve. And as long as the labor market remains strong, that gives the Fed confidence that they don't need to start cutting rates very quickly. So what we're looking for here is something that says the Fed has to cut rates more urgently. That should be the most impact. So if you have the headline coming in below 80,000, if we see the unemployment rate coming in above 3.9%, if we see the average earnings coming in, moving lower below 0.1%, if we see this coming in negatively across the board, what we'll be looking for there is that to lift gold, lift stocks, and send the dollar lower. So it would lift like euro, US dollar, for instance. So just to be aware, very weak jobs data should send gold higher. It should send real yields lower. The dollar lower should lift gold, should lift stocks. If we see very strong jobs data, we expect the opposite reaction. It means that the US economy could take more interest rate hikes. So if we saw very high jobs, 200,000 plus, unemployment coming in, 3.6% or lower, average earnings coming in 0.4% or higher, if that's all moving to the upside and that's a strong labor market, then it means the Fed will be less likely to cut interest rates as aggressively. Maybe they'll keep on hold more likely. That should lift the dollar. That should send stocks lower. That should send gold lower as a snap reaction. Also got Canadian jobs data out as well. Bank of Canada, they're sort of in a scenario where, Governor Macklem has been saying just heading into the end of 2023 that rates could be restrictive enough. Last CPI numbers have been sort of generally encouraging, but the latest CPI print did run higher than markets were expecting. So, strong jobs data, you expect that to lift the CAD. Okay, so if it comes in above 28.3, if the unemployment rate below 5.8, and if the majority of those extra jobs are full-time, expect that to lift the CAD. Look to pair the CAD at a time with a weaker currency, and bear in mind it's released the same time as the US. So if this is very weak here for the US, very strong here for the CAD, then you could see a nice reaction in dollar CAD downside, for instance. Finally got US ISM non-manufacturing PMI. I'm not expecting big moves there, but if we did see an out of consensus print, you'd expect below market consensus to send the dollar lower, above market consensus to send the dollar higher. So just be aware of that, particularly if you're in any positions post the non-farm payrolls print. So it's quite a good start to the year. We do have some significant data points to be looking out for, and there could be some good opportunities to keep on our radar for the short-term economic trading events on the calendar.